The European logistics market is thriving and it's one of the strongest performing sectors for a couple of reasons. The first and by far the most important reason is the growth in online sales and the rise of e-commerce. We are all starting to buy much more online than ever before, and this is a structural trend that got accelerated during COVID. And for every billion spent online, we need 900,000 square feet extra logistics space. So that's the strongest driver behind the increase in demand for logistics space. But we also see an increase in the building of inventory levels. Long-distance supply chains in particular have proved to be quite vulnerable during COVID times, and we have recently also seen it with the Suez Channel blocking by a big boat. So in order to make this long-distance supply chain more resilient, companies are holding larger inventories, which means that they need more logistics space. And on top of that, we see the trend of nearshoring, which basically means that companies are moving back some of their production facilities from Asia back to Europe, again to make the supply chain more resilient. But this is also made possible because of increased automation and robotization. So all in all, demand for logistics space is really strong and supply can't keep up with that, which basically led to an undersupplied situation with vacancy at historic lowest levels of around 4% at the moment. So strong demand, lack of supply means that the only way rents can go is up. We're experiencing rental growth in Europe, which is further supported by the rise in building costs, construction costs. So the cost for raw materials, timber, iron, but also for labor and land is going up, supporting rental growth even further. So it's not difficult to understand why many investors have put logistics on top of the wish list and why a wall of capital is coming to the market, leading to further capital growth, making this really a story of growth. So over the years, we've built a very high quality, well-diversified portfolio across Europe with 24 assets that are all located on established location where you'll find a lot of logistic activity, and all assets have modern specifications in line with today's requirements by tenants. Our focus is on last mile and urban logistics, mid-sized big boxes, because we think this is the part of the market that is most liquid, where we can find assets that have a second life, which is crucial for an income-driven strategy as ours. But this is also the part of the market where we have higher growth expectations because there is a lot of demand from parcel delivery specialists, for example, for these kind of locations. And that is the part of the market that's growing so heavily thanks to the rise of e-commerce. In terms of our geographical focus, we're focusing on the continent, not so much on the UK, for a couple of reasons. The first reason is that we think on the continent we will benefit from lower financing costs, as the German banks are really active over here. Also, a standard lease agreement on the continent has full CPI indexation, which is very important, I think, in today's market with high inflation. And we think Europe is slightly behind the growth in online sales if compared with the UK. So we really think the opportunity sits over here. We have built high exposure to the Netherlands. This is due to the fact that the Netherlands is seen as the gateway to the West European market, thanks to the port of Rotterdam, which is the largest port in Europe. We've also built exposure to Germany in the Frankfurt Rhein-Main region. We've bought assets in Poland, where the manufacturing industry is really dominant. We've bought assets in France. And we have built our exposure and increased our exposure to Spain with a milestone transaction in December. We've bought a portfolio for 227 million euros with 7 existing warehouses and 1 development, which is going to be delivered in the second quarter of this year. And I think it's a really good example of an urban logistic warehouse with mid-sized big boxes. First of all, Madrid is, after London and Paris, the 3rd largest city in Europe. The assets are located alongside the north-south corridor and alongside the ring road, and explains Why Amazon is our main tenant in this portfolio? Because within 30 minutes driving distance, you will find 6 million consumers. So it's very well accessible and it's very, very urban. Other tenants are MCR. They are working very closely together with Amazon, explaining why they want to be here. Carrefour, a supermarket chain. We also have Arrival, specialized in the manufacturing of electrical vehicles, and Talentum, specialized in marketing materials. So a very strong covenant tenant base that are in buildings that have been recently built. So first phase was developed in 2019 and the final phase will be delivered soon. So these buildings tick all the boxes in terms of the modern requirements, with the right amount of capacity for the floor bearing, the eaves, the number of loading doors, LED lighting, yard depth. All these boxes have been ticked. So a high quality portfolio with strong ESG credentials, and that's something where Aceli is also very dominant in. We are sector leader in the GRESB survey in a peer group with 6 other companies that are having the same sort of strategy as we have, focusing on the European logistics. We are sector leader, meaning that ESG is really on top of our agenda. Performance held up really well. We have achieved double-digit return figures. Performance has been strongly supported by the rent collection, which held up really well. It almost feels like the logistic market has not experienced any impact from COVID. So strong rent collection, and also, of course, we have benefited from the structural tailwinds in the sector. So overall, in the last 12 months up to Q3, we had a NAV total return of 17.5%. And since we IPO'd in December 2017, we have had a 30.4% total return. The shareholder total return figure was 13.1% and 39.2% since IPO. So really, really strong performance. The trust is paying out quarterly dividends. In the last 4 quarters, we have paid out 5.64 cents per share, which equals 4.84 pence in sterling. I think in terms of the inflation and the impact of inflation on our performance going forward, I think in the year 2021, the average inflation in the Eurozone was 5%. And as I mentioned, on the continent, we are normally benefiting from full CPI indexation of rents year after year. So that will really help us to increase our income stream going forward. Well, the trust is growing. We have several projects we're currently working on, and we have a near-term funding requirement of 142 million euros. Composed by the phase 4 of the Spanish Madrid portfolio, which is currently still under construction. That is 73 million. That is the building for Amazon with a 25 years lease. We are exclusive on 2 deals and currently in due diligence in France and the Netherlands for a total amount of 49 million. We also have an extension project for one of our tenants in portfolio in Waddinxveen, which requires 5 million and gives us a very attractive yield on cost. We have also drawn 15.5 million on the revolving credit facility that we have, so that makes 142 in total. At the same time, we continue to monitor the market for interesting investment opportunities together with our local transaction managers. So I think one of the unique selling points of abrdn as a house is that we are one of the larger investors, real estate investors in Europe. We have 7 offices across Europe, which gives us access to on and off market opportunities and the best possible deals for our clients.